You have probably heard that asset allocation is critical for a well-balanced investment portfolio. Not only can it reduce the risks you're exposed to by not putting all eggs in one basket, but it can also help grow and protect your net worth based on your life stage. Conventional wisdom says use your age as a guide to split your portfolio between stocks and bonds. For example, at age 30, 30% of your assets should be in bonds and 70% in stocks. At age 45, 45% should be in bonds and 55% in stocks. This is the rule of 100. Take higher risks when you are young, take a more conservative approach as you grow older. I disagree with this allocation approach for the sake of risk management. Why? Because everyone has different goals and life circumstances. Buffett once said, the best way to minimize risk is to think. My name is Eric C. Thank you for visiting my channel, Retire with Eric, the investing series created to help you reach your financial freedom. Today, I want to talk about looking at asset allocation from a different perspective, unconventionally. This way of thinking has helped me tremendously reaching my retirement goals with winning portfolios. So please stay tuned. I'm going to cover this topic in two parts. Firstly, my perspective asset allocation management and asset classes. Secondly, how I build portfolios across different asset classes using a three-step approach. In my last video, I shared with you the two ETFs to buy and hold forever. The purpose of that video is less about the two ETF products, rather more about seeing the big picture when investing. That is, looking at things from an elevated level. The big picture for portfolio and asset allocation management is to look at assets as tools or resources that you deploy and manage to work for you. If you're a manager with employees who work for you, your goal is to understand each employee's capabilities and then leverage their strength to form a productive winning team. Also, as a manager, you need a contingency plan in case a team member wins the lotteries tomorrow and quits. This is an easy concept. Managing your assets to form a winning portfolio through proper diversification is no different. You want to make sure that the assets you picked are contributing constantly by playing both defense and offense in growing your net worth. First, let me break down some examples of common assets. Equities, such as company stocks and benchmark index tracking ETFs. Fixed income, such as bonds. Real estate, including land, residential, and commercial properties. Commodities and precious metals, such as oil, wheat, gold, and silver. Alternatives, such as arts, collectibles, and Bitcoin. Cash and cash equivalent, such as money market funds or CDs. And consumable assets, such as cars. No matter how many asset types are out there, I would group them into three categories: value generating assets, value preserving assets, and value losing assets. So which assets should you own and manage? Well, it depends. Some assets sometimes belong to two different categories. For example, a brand new car starts to lose its value as soon as it leaves the parking lot, but it starts to generate value if you rent it out on a car sharing app such as Tora and ensure it is a cash positive endeavor. Your primary home depreciates year over year while you spend thousands to maintain it. It is a value losing asset. However, the land it's on increases in value over time. And if you rent a portion out to tenants, it might even become a value generating asset. So the goal is to reduce the number of value losing assets, or at least slow down the depreciation if you must own them, and then invest and acquire value preserving and generating assets. A great way to do this is through passive investing, unless you really enjoy working actively on managing certain assets as a business, such as house flipping, commercial real estate investing and management, or day trading stocks or options. Assets such as gold, land, collectibles, even arguably Bitcoin preserve value long term, following the law of supply and demand. Take Bitcoin. It has forever fixed number of quantities available, but such assets don't really create value unlike a company productively offering new products or services to make our lives better. Next, in part 2 of this video, I'm going to share a three-step process to build winning portfolios. The reason I don't follow the so-called rule of 100 or similar for asset allocation is that, for one, when it comes to my finances, I want to be the one to create my own rules. And two, I set my personal specific financial goals. So I take the bottom-up approach to deploy assets across multiple classes to create a strategy that fits my goals. And I have never owned bonds. Let me explain what this three-step approach is. Step number one, I define my goals, which change over time. For example, when I was younger, my goal was to reach financial freedom sooner so that I can depend less on things I didn't control, while being able to travel and experience new things. Now I'm retired, I have a goal to continue having my assets generate enough cash flow to cover cost of living without reducing the principal amount, and at the same time grow my net worth further until I'm eligible to tap into my retirement accounts. Step number two, I investigate different types of assets, their characteristics and risk profiles, so that I can form mixed asset portfolios to achieve my defined goals. I understand that why I invest in index-based ETFs, which I shared in my last video. I also understand that indexes don't go up in straight lines. They have their valleys and cycles, just like the economy, but eventually will reach higher highs. I understand that those valleys generally don't last more than 2 years in my generation. You may call this risky. I call it business cycles. That things needs to go through some rough patches once in a while as part of the development process before achieving new accomplishments. Even one of the greatest companies, Apple, was on the blink of bankruptcy in the 90s until Jobs came back as the CEO. Not only did he save the company by introducing a slew of innovative products, but he also turned it into the most valuable companies in the world. That's also why I don't allocate more than 8% to a single stock in my old stock portfolio, even for Apple. I understand that equities are value generating assets. I also understand that land value appreciates long term as long as the US population continues to grow. People need a place to live, and many prefer single family homes for space and privacy. So I acquire the single family house that meets my condition of positive cash flow. This means the rent I collect will be greater than the expenses I pay for mortgage, property management, taxes, insurance, and repairs. Such property is a value generating and preserving asset. I don't invest in non cash flow passive properties even though it might be obvious that its value will go up in the future. This is because I use a loan to acquire it, a leverage that can hurt me painfully during a real estate downturn, which will force me to sell at a loss. The positive cash flow condition allows me to weather through the storm until recovery. I will share more with you on my real estate investing learnings in the future. Due to the nature of boom bust economic and market cycles, and since I'm retired, I built a higher cash reserve for living expenses that lasts at least a year while maintaining the same standard of living as before retirement. I don't invest in bonds because longer term I know that equity index funds has outperformed bonds. And bonds can also lose value when interest rates rise unless I hold them until maturity. I prefer to have high yield money market funds or CDs, which can now generate above 4% returns without value fluctuations. They are in fact part of my cash reserves. As previously mentioned, besides my forever holding ETFs, I do have an old stock portfolio, which keeps me on top of less than 20 individual companies which dominate in their respective industries. Most of them are in the S&P 500 or Nasdaq 100 index. This is a form of concentration as opposed to diversification. I do this because I personally believe in this company for making our lives better with their superb products and services. I understand the value that they create, and I want to be part of their success and growth. The risk is actually higher for me for not investing in them. By the way, I will dedicate a video to welcome a new addition to my forever holding ETFs. Finally, I have an options-only portfolio and an Bitcoin ETF per an allocated portion that I can afford to lose. I will explain the rationale behind them in the future as well. Let's look at my portfolios. As you can see from these charts, each asset class is allocated accordingly based on a predetermined weighting and its purpose, as previously explained. I'm not only building one single portfolio, but I have teams of portfolios. And within each team, there are several contributors. For instance, my old stock team consists of 20 different individual stocks. Just like the organization of a company, to make it operate successfully, the company CEO needs to ensure each team works collectively per their functions. I am the CEO of my asset portfolios. Since 2008, at the low point of the great financial crisis until now, my net worth has grown at a compound annual growth rate of 20%, or snowballed 18 folds by just following the three-step approach. This leads me to explain the final step to complete building my winning portfolios. As individual stocks or assets change value, causing their weightings to shift out of proportion, I will periodically rebalancing them back toward the predetermined allocation percentage. For instance, when the market indexes have recently climbed to historical highs, the PEs of some of those underlying companies have elevated high enough to require a perfect business growth trajectory into the future. This is when I would take some winning chips off the table. I will later reinvest the offline cash back into certain assets when the market goes through a correction cycle. Rebalancing means monitoring the current percentage or weightings of your assets against the predetermined numbers and adjusting accordingly. This requires certain discipline, but it is imperative. As I saved money from salary, I continue to inject new funding into my portfolios, allowing them to compound further, which enhance the snowball effect illustrated earlier. I would not sell off one asset class entirely during rebalancing unless the underlying thesis is no longer valid. For example, if the US population begins deaccelerating or experiencing negative growth like Japan and China, I would start to reduce my real estate exposure toward zero. However, I do sell off one specific asset contributor position if it doesn't perform, like I would let go an underperforming employee who works for me. As my goals evolve over time, the types of asset classes I include also evolve with a new set of to be determined allocation weightings. This process is called restructuring. I do this every 1 to 2 years by repeating the three-step approach. Hey, doesn't this sound familiar to the corporate folks here? Net worth growth takes time, and I don't believe in nor trust any get rich quick schemes. So lower your expectations, but start early. I hope you find this episode helpful and begin constructing your winning portfolios with your own asset allocation strategy. Optimizing your portfolio is a work in progress, but the mindset change of starting asset allocation exercise will benefit you for the long haul. Be the CEO of your investment portfolios. If you already have a successful allocation strategy, please share below. This will help the community to learn. Appreciate your time invested watching this video. Please subscribe and click the like button. See you all soon.